a little bit more in depth. These are all going out over the Christmas holidays, so just kind of recording them now. People want early access and join Discord or join the newsletter. So basically, last week was the very, very, very basics. This week is more kind of just going that extra step further, going into the details of why stuff works and how stuff works and what you should be on the lookout for and how to kind of apply it in your own day-to-day maneuvering on chain and stuff like that. So primary focus is trading, lending, borrowing, yield farming, airdrops. Is it really free money? All that kind of good stuff. And then a bit of a running order. So just going into smart contracts, basic smart contracts, risk associated with smart contracts, key DeFi applications, centralized exchanges, AMMs, Uniswap, Raydium, all that good stuff, slippage, phantom settings, lending, borrowing platforms like Kamino and Aave, yield farming and staking, LSTs, LRTs, auto compounders, liquidity pools, yield generation. So basically everything you need to kind of get off the ground. This one will be a little bit more in depth. There might be some stuff you'll learn here today, that even if you're quite a seasoned on-chain veteran. So yeah, and if there's any questions, always just leave them in the chat or ping me in Discord. I'm always happy to answer them. So again, it's primarily going to be a Solana demo, but I might use Uniswap as a demonstration of how decentralized exchanges work and how AMMs work, as it was technically the first automated market maker, and that'll make a lot more sense as we further get into it. But yeah, so it's primarily going to be like a Solana-based demo where we're operating on Solana as the chain. Basically, everything that you do with these kind of tricks and tips will be kind of replicable on any EVM chain anywhere. So yeah, and if there is demand, let us know in the comments or in Discord, and I will do more EVM focused one. Maybe I'll do it on Base or maybe on Sonic or something like that. But if you're unsure throughout what we've got going on today, just ask. There's no stupid questions. There's a lot of stuff that is quite technical. I'll try and break it down to as simple terms as physically possible. So again, if you need me to stop or kind of recap something, just let us know. Just to kind of point out again, for OPSEC reasons, please, I will not DM anyone. I will not be kind of asking for your wallet or your seed phrase or anything like that. Anyone who does is a scammer. Check in Discord to kind of verify who the people are that are messaging you, blah, 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 blah. I'll stay on at the end 5 minutes if there's any questions. If not, it's all recorded, so you can listen back to it. This is going to be pushed out to public probably in that limbo period between Christmas and New Year's, so people might want to rewatch it and kind of put into practice some of the stuff that they've learned, or we will send it out to people who subscribe to the newsletter, or this kind of very link in the announcements channel in Blockmates Discord will kind of remain permanent, so you can kind of come and revisit it. But we wanted to give early access whilst we're doing the live recording of the videos that we plan to go out over Christmas to people who joined in, so make it a bit more interactive as well. So first of all, smart contracts. Everyone might have heard of smart contracts. Like, what is it? What does it do? Why are they called smart contracts? Well, in actual fact, they're not actually smart. They're pretty dumb, to be honest. It's kind of like a, if this happens, then do that, with a lot of kind of basic function, what you get across software. So the beauty of them, though, and I won't kind of just shit on them for too long, is they remove any need for middleman. So like, think about Bitcoin, me being able to send to you X amount of Bitcoin any time of the day. You can be anywhere, I can be anywhere, and you know that there's not going through any intermediary. It's going to be validated by a series of miners that are across the Bitcoin network, and everyone's going to say, yes, that is correct, or yes, or no, that might be a fraudulent transaction. So taking it a step further, you've got smart contracts where I suppose the image is showing the most basic fundamental understanding of how you can kind of wrap your head around it if you come in completely cold to it. So let's say you are buying a house, and so on this example, we've got Stan who wants to buy a house, and then we've got Roger, who is the seller of said house. Stan wants to buy it. He's got the cash. He has to go to lawyers, brokers, insurers, real estate agents, like all that kind of good stuff in the middle. And the seller, he also has to kind of deal with all those kind of people as well. They want their cut. A lot of it is just bureaucratic nightmare. A lot of it is just wasted energy, efficiency, and cash. And it's a pain in the ass. If anyone's been through any kind of process with a middleman, it is horrendous. When at the end of the day, it's just, I have this, I want that. And then the same is true for the reverse. So what smart contracts actually allow is a predefined set of principles. So if this happens, then do that. So think about this. If Stan puts $1 million into said housing contract, Roger will sell to Stan. That's like the most primitive version of how I can kind of explain it. So no middlemen, nobody taking a cut, nobody kind of like, oh, you need to prove this, you need to prove that. It's just like code is law. If this happens, then do that. Obviously, we don't have people actually processing housing payments through smart contracts yet. There are a few teams kind of building something towards that, but I suppose at the end of the day, it's a trustless way to be able to kind of have what would typically be a process which could have ambiguity. It could have a lot of inefficiencies with regards to kind of how many people get involved. And then when you bring it on chain and you put it into a financial context, what we're going to go through for the rest of the seminar, I'll show you how powerful these things can be, because effectively every application that is running on Solana or Ethereum anywhere is running on a smart contract. And all it is a checks and balances. And if this do that kind of contract, how complex these things get and how important they can be once we get to it. So TLDR, trustless software, no middlemen, basically do any function that a typical regular in real life contract can do. But they're not great. And they're not perfect. So over 9.1 billion has been hacked from smart contracts. Over 2.87 billion alone has been hacked from bridges. So that means if I'm on chain A and I want to go to chain B, usually there is like a huge pot of liquidity in the middle that allows me to be able to go from chain A to chain B with a specific asset. So it could be a lot of USDC, which is the stable coin that we went through on the last episode. I want to go from, I don't know, Arbitrum to Base. And then those bridges were obviously a huge honeypot for anyone who wanted to hack them. And a shitload of capital tied up on there. So they were kind of like not an easy target, but they were, the attack surface was drastically larger and the upside for nefarious actors was, quite appealing. So like there's been a huge portion of bridges that have been hacked and they are running on smart contracts. North Korea, yes, it is true. North Korea do have huge coordinated attacks on the industry, and they've seemed to have found a lot of vulnerabilities within smart contracts, which is kind of wild to think about. What it comes down to is Solidity, which is like the EVM programming language, is not the greatest programming language, to be completely honest. We have relatively poor audits or lack thereof, and people just kind of stamping an audit and charging a team $50,000 or $100,000 or $1 million, and then saying, "Away you go, we checked it, it looks okay." There's these zero-day exploits, re-entrancy attacks, social engineering, where how can you put this? Like someone might get access to someone's seed phrase by sending them a malicious link, and then that seed phrase might have been one of the signatures to enable, I don't know, one of the smart contracts to allow transfer of funds or something along those lines. But there's a lot of these social engineering hacks or SIM swaps and stuff like that goes on as well. So the industry is moving towards these interesting kind of like hack detection. So like if there's any like odd calls or pings to the contracts, then it will pick it up and kind of like, I suppose, put it to some form of cool down period, so like no funds are really lost. The industry is also deciding that audit competitions where everything's out in the open, and then you hit whatever kind of bugs that you pick up from your, I suppose, freelance audit that you can pick up, and then you can earn like quite some handsome rewards there. At Code for Arena is like a really, really good site to kind of see all the, I suppose, bounties and audit competitions that go on there. A new thing, if anyone's paid attention the other couple of days, is a new product called Movement Labs that I've just launched, and they are built on a programming language called Move. So is Sui and so is Aptos. They were the originators. They were the founders of the language before they split up. It was actually generated from the Facebook project DM, and then they split up when that kind of project got disbanded, and they changed into Sui and Aptos, and then Move is a new Move-based language that is supposedly a lot more siloed. So there's a lot of checks and balances between kind of, I suppose, the point of hack to the point of which funds could be transferred or funds could be drained. So we're moving towards it, but we're still quite a way away. So everything, as I say, like standard operating procedure for me, never deposit more than you can afford to lose in any of these protocols or any of these smart contracts, and kind of have a look at like track record. Track record's a really, really good indicator of, like, I suppose, this idea of lindiness. If it can stick around for a long period of time and not get hacked, then it's usually onto a winner. So key apps or dApps, decentralized applications, and use cases. So we have decentralized exchanges, which are DEXes, Hyperliquid, Uniswap, Raydium, and then we have DEX aggregators, so which is Jupiter, which we went through last week, why Jupiter can offer the best price. And then you have decentralized oracles, where they bring the off-chain data on-chain. So basically what that means is if you need a price feed from Binance or you need a price feed from Bybit or Coinbase, you can kind of call that API into your protocol. J-Link's going to verify that it's correct, and then it's going to go into the decentralized protocol. So it's like this checks and balances between bringing the off-chain data on-chain to make sure we can kind of get the best of both worlds and get the best kind of use cases of the APIs that are in the real world and bring them on-chain. So decentralized stablecoins such as DAI, Maker DAO has been around for a hell of a long time now. They recently went through a rebrand, which, not to go off on a tangent, but I think is a stupid idea. And then Athena with USDE, been absolutely killing it. And I'll get into what a couple of these mean later and why they're different from regular stablecoins, which we covered last week, like USDT and USDC. And then you've got lending and borrowing protocols like Aave, Kamino, staking and liquid staking protocols like Jito, Lido, Renzo. There's a whole load what we'll get into, like Eigenlayer and things like that. So yeah, cool. So DEX overview, so decentralized exchange overview. As I said, that is a set of smart contracts that allows anyone to trade with a liquidity pool. So a liquidity pool is just basically, you think about it as a pool of tokens where people can contribute to the pool, and all they want in return is every time there's a trade that happens between that pool, they get a cut of the fee. Right? I'm going to go into this a little bit more in detail, but that is, if you use Uniswap or you use Raydium, then that's what you've been trading in and out of. There is a new kid on the block, which is Hyperliquid. That is kind of taking the industry by storm, and that is a little bit different. So we're going to get into that, why it's different, and what the pros and cons of them both are. So Hyperliquid looks, I suppose the UI looks like this. It looks like, well, if you took a glance at it, it looks like a Binance, or it looks like a Coinbase Pro or Kraken. It looks just like what you'd expect from a centralized exchange, right? So this is a centralized limit order book or a decentralized limit order book. It technically is slightly centralized, but because they've only got 4 or 5 validators or something. So more decentralized than Binance, but not as decentralized as what we're going to get into next. But just to kind of highlight the point, we have an order book here. So basically, like, think about it as you line up, you've got tokens to sell, and then you want to list them at which price you want to sell them. Or people line up, they've got stable coins and they want to buy, and they're going to list at which price they're willing to purchase it from. And then you just get this order book that's created off it. So these are all orders that are willing to kind of sell at this price, and these are all orders that are willing to buy at this price. And then you kind of get market makers that kind of, like, I suppose, close the gap in between. Order books are kind of like the standard across all of finance, to be completely honest, of how exchanges do work. But until recently, they've been pretty hard to bring on chain because they were quite gas intensive. Like thinking back to Ethereum early days, I think it was called like Ether Delta, like one of the truly early decentralized limit order books on Ethereum. It just didn't work. There was no liquidity there. It was too slow. Orders, by the time you placed an order and when it actually got confirmed and when it got filled, like the prices were just so out of whack that it just didn't make any sense. So, but now we've got these kind of high performing chains, got a lot of liquidity coming on chain. So it's now kind of like the infrastructure is there to enable this to kind of work. But this is probably going to converge into a bit of a trend that you start to see on chain order books for spot assets and for perpetuals. So we'll see how that goes. Hyperliquid are kind of leading the charge there. They've got a really, really good product. But if you've used Uniswap, if you've used Raydium, you have used what is known as an automated market maker, which is the type of decentralized exchange it is. And as I said, it's in these examples, we're going to use ETH and USDC or ETH or Sol and USDC, right? All an automated market maker is a liquidity pool where people can come along and let's say it's a fixed amount. Let's say ETH is 4K for round numbers sake, and you got $4,000, right? So you got a collective portfolio of $8,000, and you want to kind of say, well, I want to provide liquidity. So you take the $8,000, so the one ETH and the $4,000, you deposit it into the ETH USDC pool, and then each time that someone swaps Ethereum for USDC or USDC for Ethereum, you're earning your pro rata share of those swap fees. So let's say they initially used to be on UniV2, there used to be a 0.3% trading fee. So let's say you own 10% of all liquidity in that pool, you then earn 10% of that 0.3% trading fee. So it's all pro rata, it's all proportional to how much liquidity you actually have in that pool. So this is just like a basic example of what happens with the liquidity provider. So using my example there, you got 3 tokens of token A and 1 token of token B. And it goes into this thing called a bonding curve, right? And all a bonding curve is a very, very simple formula. So it's X times Y equals K. It's constant sum. And effectively, it just means the more in-demand token is getting removed from the pool, right? Don't try and overcomplicate it like from that. If you have ETH and USDC in a pool, what is happening when ETH is going up? All that's happening is people are coming to the pool, depositing USDC in and taking ETH out, right? So the more scarce asset increases in value, right? The same is also true when ETH is on a downturn. People are getting rid of their ETH by depositing it into the pool and taking the USDC. So now the USDC is the more in-demand asset. Hence, in relation to ETH, the USDC appears to be still, but it's just like this ebbs and flows, ebbs and flows, ebbs and flows. Which one's in demand? ETH's in demand, right? So ETH's going up in price and it's getting removed from the pool. And that's how the bonding curve works out the price, right? So just think of it as simple terms as physically possible, like that. So in-demand token gets removed from the pool, right? Really simple. So and this is the trade. This is what's happening on the trader side. So as I say, the input is right. I've got 3 tokens of token A, and then there's a 0.3% fee. As we mentioned previously, that 0.3% fee is then getting distributed to everyone who's providing liquidity to that pool. So what does a liquidity provider want? They want lots of swaps to happen. They want lots of swaps to happen with like really, really big size. So if someone comes along and does $1 million swap, there's a 0.3% fee attached to that, and then that gets distributed. What do they also want? They want to own as much of that pool as possible. So they want to go into a pool that has lots of volume going through it, lots of trading going through it. So that accounts for lots of fees. And they want to kind of like own the lion's share of that pool. So that 0.3%, when it gets distributed to everyone, they get the lion's share of that. So that's what you're kind of looking for. Those are the opportunities that people look for. You want high volume and low competition within the pool. And then I suppose that incentivizes more people to put into the pool. That dilutes your share of the pool. But then that means people can come in with larger size and trade because you're not going to get this crazy slippage that happens from having low liquidity. So that's the basics of how that works. I'm just going to bring it up on Uniswap and then on Raydium. So obviously Uniswap is only on EVM, but just to kind of highlight a point, let's have a look. So example for, let me just see what it, so I wanted to deposit 1 ETH in, I'd have to put 3,930.83 blah 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 blah. And then basically that would just be deposited into the USDC ETH pool. And as you can see from here, there's a 0.3% fee on there. And that's on a UniV2 position. The difference being now there are UniV3 positions where, I don't know if I should go into this because it might be a little bit too technical. So it's a little bit more granular, right? So you can have ETH and USDC, and then there's different pools that have kind of a different swap rate, right? So if you go for this pool, there's $2.4 million in TVL, but you're only getting 0.01% for every kind of swap that happens. So not great. You'd ideally want a lot of volume to go through that, but again, the 0.01% fee is not good. The vast majority of people have opted for this 0.05. It seems to be the sweet spot. Less so on the 0.3. As I said, that used to be the UniV2 kind of fee model. And then a 1%. So it's best for exotic pairs. So when like you got two kind of volatile assets against each other, you want to be compensated for doing that. And that's why like the 1% fee is on there. So right. I'm going to attempt to show you what I mean by UniV3 because it can get a little bit complicated. But if it's going over your head, just ignore me for the next 2 minutes. And you don't need to worry about it unless you're providing liquidity, really. So let me get back to this slide. This bonding curve, right, which is effectively the curve that shows the price of the asset. On UniV2, what you were doing was supplying equal parts USDC, equal parts ETH, or equal parts ETH, equal parts Bitcoin. Like any two assets, it doesn't matter what it is, you can supply it. That's on Raydium, and that's on any decentralized exchange. That is an automated market maker. What is happening here is, again, using our ETH and USDC example, when you're depositing on UniV2, you're literally depositing saying, I am happy to provide liquidity for any trader at any price. So that's from 0 to infinity, right? That's a big curve. Right? That's a very, very, very long infinite bonding curve, right? That's not very capital efficient because it's never really going to trade at 0 and ETH is never going to trade at infinity. And there's a big chasm in between that. ETH's probably going to trade around its price, right? Plus or minus 10, maybe a wild day of 20%. You're never really going to get much variation around that. So why would you have your liquidity spread across the whole bonding curve? It doesn't really make any sense because you're not earning fees at 0 and you're not earning fees at infinity, and you're not earning fees when it's like not in and around the price range. So what Uniswap did and what the industry did is kind of evolve towards this thing of concentrated liquidity. So concentrated liquidity, let me see if I can, there we go. Add liquidity, UniV3. So what they did is allowed you to select the range on the bonding curve of where you're happy to provide liquidity. So let's say for round numbers sake, ETH is at $4,000 and you're providing liquidity. You're like, I think ETH's probably just going to stay in like a plus or minus 10% range. So you can actually just take the same amount of liquidity that you're going to deploy on UniV2, right? That 8K, that 4,000 USDC, and that 1 ETH, notional value of 8,000. And now you can just go and, instead of deploying it across the UniV2 bonding curve, which is from 0 to infinity, not very capital efficient, not earning great fees, you can then go and deposit it at only between the ranges of 3,600 and 4,400. So every time ETH and USDC trade between those two numbers, you're earning fees. And the beauty of it is all of your capital is spread in a more concentrated format between that range. If it goes out, then you don't earn any fees. So if ETH goes to 4,401, you will be effectively knocked out all the way into USDC. The same is also true as ETH went down to 3,599 out of your range. So the opposite side, again, what did I say earlier? The more in-demand token is the one left in the pool. So in that case, when ETH is dropping, goes below your range, you're left with the ETH because it's the less in-demand token. Same on the upside. Don't worry about that too much, but that's just how concentrate liquidity in UniV2 and UniV3 work. There's UniV4 that's coming on the horizon. That's going to be a whole different ballgame, but I just want to kind of bring that up. So, and why would you want to do this? Let me just see. So why would you want to provide liquidity, or why would you want to, make sure you're only trading on a DEX? So let's just have a look. Right now, we know that a specific liquidity pool, you want high volume, you want lots of transactions. If you're providing liquidity, because you're getting your pro rata share of that fee, and ideally you find the pool before everyone else, so you can kind of get the largest proportion of that pool. Right. So look at some of these rewards. Sol USDC on Raydium, there is $8.8 million worth of liquidity, and over the last 24 hours, there's been $300 million worth of volume. And that's at a 0.01% fee. So in the last 24 hours, if you work that out, the difference between the volume and the fee is 29,723, which gets distributed between proportionally to $8.847 million worth of liquidity, right? So let's say that again. There's been $297 million worth of volume through the USDC Sol pool on Raydium, which at 0.01% fee generates fees of 29,723. And then that has to get shared between everyone who has contributed to the liquidity in the pool, which is 8.874 million, right? So let's say you actually own 10% of all the liquidity in here. So let's say you own like 887,000, like roughly 10%, right? In the last 24 hours, you will have earned $2,972.3, right? Because it's your proportional share of the liquidity. Same again, if you own 1% of the pool, so if you had 87K in there, you'll have earned $297 or something. Okay. And annualized, that comes out at roughly 124% a year, which is good going. So 124% here is broken up into two little baskets. So the trade fees are accounting for the lion's share. Good. This is what you want to see. You don't want to see everything being propped up by token emissions and stuff like that. It's just a game you don't want to play. And then they're also kind of boosting the pool a little bit with let me just see. Yeah, 1.93% over the year is coming from Ray tokens as well. So not only are you getting the trading fees in rewards from Solana, from the Sol token, USDC token, you're also getting a little additional boost in Ray tokens. Where things get really crazy, so so Magic Eden's token has recently launched. So this has only been live for, I believe, 2 days. And this is what I mean. Early opportunities, high volume. It's exactly what you want. So you've got a lot of people claiming the airdrop. You've got a lot of people that are just trading it, like trying to find the bottom. Is it going to go higher? Blah, blah, blah. A lot of attention, a lot of kind of speculation, and a lot of volume going through the pool. So you've seen 57.4, well, nearly $57.5 million worth of volume in a pool that only has $4.18 million worth of liquidity. So that's generated some fees in the last 24 hours of $143,000 worth, and then that only has to get distributed between 4.18 million, which annualized turns out to be roughly 1,261%. But we know that's not going to last. We know the volume is probably going to drop off. We know the liquidity is probably going to increase. So it's just one to kind of keep an eye on until you're kind of like satisfied that, right, you're happy to kind of hold both tokens. So we understand how that works. Any of these tokens, you should basically be able to know how to kind of deposit in. Let's say we're doing Sol USDC. Let me just say 7. So I'm going to provide some liquidity now on Raydium. Yep. It's typical. So I want to provide some Sol and some USDC. So I've got my Sol, got my USDC. Excuse me. I've gone to liquidity. I've gone to the pool. There's also a 0.2% pool here. So basically what you want to look at is what's the APR. This is like probably half. So because what's going to happen here is Jupiter's going to route it through the best price pool, and so it's going to go to USDC 0.01%. So deposit, how much Sol you want to put in, or you just max out the bottom one. So 1,594 plus 6.38, create position. Let's see if this goes through. No, didn't go through. All right. So a little bit more granular detail. Let's have a little quick look at what Solana price is. Right. So Sol's at 231. I'm going to say between 221 and 259 is the range. I think that's kind of like a range on the daily anyway. So anywhere between this trading range. So I'm happy for myself to earn fees between this 222 and 259. That's just kind of the range that I've set out on a higher time frame. Kind of broke this resistance, busted through it, kind of had a deviation, then we're back into the range. So anywhere between this, I'm happy to kind of earn fees. So I'm going to go and set that now on here. So 222. Let me just knock that down to 221. And then I said 25. I wanted to put 260, just $1 above 259, which was previous all-time high. So in between 220 and 260, I'm going to be earning didn't mean to do that. 221, 260. I'm going to be earning trading fees. So I'm going to max that out. 8. There we go. Cool. So your deposit is represented as an NFT. You can trade that NFT if you want, but just don't. And then you can just go and check your positions on the portfolio dashboard. So it's saying I'm in range, so I'm earning fees. Happy days. I started off with 7.94 Sol and $735 USDC. Trading fees looking at roughly 98.4% annualized. So yeah, all happy days. Then you can kind of just monitor this, see if it's worth your while, and then away you go. So there's a thing called impermanent loss, which I'm going to try and explain in the best way possible. So let's use AI16Z, right? This is like probably a month or two old, really hot project, lot of high prospects. Oh, just a question. What's the whole benefit of concentrated liquidity? Isn't it better if my liquidity is a wide range of earning fees? No, because as I mentioned, like when you're providing liquidity across a full range, Think about it at like what's the best way to describe this? Think about that range from 0 to infinity, right? So the question is, what's the benefit of constraint liquidity? Isn't it better if my liquidity is provided from a wide range, earning fees from like 0 to infinity? Right. Yes and no, right? If you want to be just sat idle, you don't want to worry about it, couldn't care less. Happy to take a lower yield, happy to take a lower APR, go for it, right? That's completely fine. You can even go and set, like, if we go back into the position, what I could have done is just sat as kind of readjusted this position. So I don't know, I put it from $5 up to $1,000, right? So I never have to worry that I'm never going to earn fees. Hopefully, maybe it all passes 1,000 one day, and that could be quite interesting. But so you don't necessarily care there. But if you want to be a little bit more strategic about it, think about it this way: the tighter you can get your range, it's going to drastically improve your APR, right? Because you've got, let's say about 8K, like let's say we have $10,000 for example. Your $10,000 has to work across, or has to be spread from 0 to infinity, right? That's not efficient. What happens if it only has to be spread from what the position that we've just put in, from 220 to 259? So every single time there's a trade that happens within that price range, you're earning fees. If it pops out either side, you're not earning fees. So you're effectively leveraging up your notional. You're leveraging up the amount of capital that you've got, trying to get it into a tighter range as possible, and making it work for you around the price that it's trading. You do also run the risk of it popping out either side and then not earning any fees, but you can always readjust. So, like, to kind of explain that, there's this thing called just-in-time liquidity, which was like a type of maximal extracted value, so MEV. So what they would do is like these bots, it'd look at large orders that were coming into liquidity pool. So like, let's say there's a $10 million order going into the USDC Sol pool. What this just-in-time liquidity would do is, like, this just-in-time liquidity attack, it's a type of MEV. It would jump ahead. It would pay a huge fee to get in there and then provide liquidity at that specific price. Fill the order at that specific price, and the vast majority of the trading fees around the price point that it went in at. And then in the next block, they just removed liquidity. So it only satisfied liquidity on demand. That's kind of going away now because you've got intents, but that's a conversation for another day. But yeah, it just depends how you want to play. If you want to set and forget and do really wide range, I think that's probably best for a lot of people. If you want to see if you can kind of juice and maximize your returns, kind of keep an active and monitor your kind of position, then a tighter range, it doesn't have to be like overly tight. Like, you could go 189 to 280, or like $100 range on Sol. I think you're gonna be fine. You're gonna have enough kind of like time to readjust if you need to. So yeah, that's kind of how that works. And the issue was as well, like on Uni V2 pools, people weren't earning enough just to kind of to counteract the impermanent loss. Okay, enhance the profitability. Yeah, 100%. So people weren't, and you've got to play that out, right? It's all well and good as us sat here doing this with our own personal portfolios. The people who are actually providing liquidity for protocols, they need to be fed as well. They need to kind of make money. They need to be profitable, or the liquidity is just going to dry up. It happened in the bear market. Liquidity dries up, and it was terrible trading experience, terrible kind of environment to trade in. So if they're a little bit more savvy, a little bit more sophisticated, and they can get a little bit extra money for kind of providing at a tighter range, they're definitely going to do it. So there need to be ways to incentivize liquidity providers. There need to be ways to incentivize traders. There need to be ways to kind of like, I don't know, just allow that flywheel to continue, and concentrate liquidity is a way to do that. So the dreaded impermanent loss is, as I was saying with this AI16Z slide, So this is a token that you're probably going to do well if you just hold it anyway. It's been doing like drastically well. Like let's say you bought it at $50 million and now it's at let's have a look. Now it's at 800 million, 880. So it's run up from like 10 million. Let's say it's done an 88x. Okay. Where is it? It's done an 88x. All right. So if you'd have been holding AI16Z, great. 88x on your money. Fantastic. Well done. Job done. What else do you need to do? Let's say you got drawn in because there's a 2000% APR, which is paying nearly, what's that, 300? It's paying nearly 5% a day. That's right, isn't it? Yeah, 6% a day, nearly. So there's $5 million, $5.3 million worth of liquidity, $303,000 in fees. Very, very juicy rewards. But think about what I said at the top when I was explaining this. The more in-demand token is the one that's taken from the pool. So all the way up, even if you'd have provided 50% AI16Z, 50% Sol on a completely wide range from 0 to infinity, every single time that the price is going up, you're getting less and less AI16Z. So if you were to remove the liquidity, then it's at, you can look at it as if it's like a trailing limit order all the way up if you're providing both. Because the more in-demand tokens getting taken out of the pool, and you've said you're happy to take either, blah, blah, blah. Then also, as more people provide liquidity, how is the APR calculated for efficiency purposes? Yeah, so as more people provide liquidity, the fees have to get distributed proportionally to everyone who's in that pool. So what you really want is high volume, and hope people haven't kind of like woken up to this being like a really high volume pool. The more people that come into the pool, all right, it might encourage larger trades to go through the pool because like liquidity is there to be able to do it because the slippage won't be as high. But you've got to be a bit greedy. This is why like a lot of yield opportunities, no one likes to talk about them. If they find a good one, they want to keep it to themselves because the more diluted it gets, the worse the yield is. So that's kind of how that works. Let's take a drink. So that was impermanent loss. Would it have worked better if you did just hold it AI16Z in this example? Versus earning 5 to 6% potentially a day. I don't know. Whatever your strategy is, whatever floats your boat. Maybe you had a shit ton of AI16Z and you wanted a way to kind of like sell out on the way up and earn fees for doing so. That's a cool strategy. I think it's a really great strategy. It's a little bit more complex, but yeah, something worth thinking about. Right. So is there any more questions or anything on the DEX side? AMMs, DEXes, order books, APRs, liquidity, any of that good stuff? Cool. Right. So optimizing trading settings. So we touched upon this briefly last week. I'm going to go into it a little bit more now. So let's say we're on Jupiter. We came here. Actually, I'm going to use AI16Z as an example. Contract address. So what am I doing here? Right. I want to take 10 Sol and buy whatever the equivalent on AI16Z is. Right. So first of all, we've got basic swap. But then we've also got the aspect of auto and manual. Right. Auto is gonna basically, just as the name says on the tin, it's going to look after all the settings for you. Problem with that is sometimes in high demand tokens that I've just launched, then you're either going to get absolutely destroyed because the settings don't work in your favor, or your transaction is just categorically not going to go through. So there has to be some give, and there has to be some kind of like there has to be some kind of consideration around that. If everyone's trying to pull an auto transaction, it's never going to go through, right? So the transaction goes through when you kind of concede on some of the aspects of the trade. So in this example, let's like really bump it up anyway, see what happens. So I was going to do this like 1,000 sol trade, $231,747 would buy me 279,200 AI16Z, which is the equivalent of $226,000. Price difference is roughly 1%. So liquidity is pretty good. You can get a trade in that size in one trade with a slippage of roughly 1%. And that's on the auto as well. So if we click into manual, then we can kind of have a little look at our settings. So auto slippage mode is dynamic. It's just going to kind of optimize for the trade at a specific time. It's going to optimize your transaction fees based on the trade at that specific time. And then you can go GTO only, or you can kind of disable GTO. So basically what that means, as it says here, avoid sandwiching or being front run comes with higher gas fees and lower transaction success, right? So as I said, there's always a compromise if you want different settings for different outcomes, right? If I was going in with that large size trade, 1,000 sol, I definitely want GTO only. So basically all that means is when you signal that you're going to trade, like the RPC triggers it goes onto the blockchain. GTO has what's the best way to describe this? Technically, its own kind of like private quote unquote pool. It doesn't necessarily work the same as what happens in EVM land, but GTO is then going to like prevent it from being sandwiched. So basically, all sandwich mean is someone sees the transaction coming through, they buy the token before you, drive the price up, sell it to you at a higher price, and then they get out in the next block, right? That's sandwiching. That's being front run. Front run is basically just the first part of that. So they see a transaction coming through. It's like a large order. It's going to drive the price up. They nip in before you at a higher gas price, and then they kind of get to the price to buy in before you. And that usually happens because you have your slippage settings set quite high. So, but going through GTO, as I say, has a lower transaction success. Or we can go to manual and then have a little look at what we want to do. So dynamic slippage mode. Dynamic slippage estimates slippage for you through simulation and heuristics, or use fix to specify the exact slippage. So dynamic is basically saying we're going to simulate this transaction as you put it through, and this is what we recommend. Pretty good. Probably should be using that, to be honest. Like if you're not going to go into the granular details of every trade. Fixed, on the other hand, is just fixed slippage may help you with transaction success, but expose you to front running. Try using GTO only turned on when you're using fixed slippage. So, what did we previously say? Fixed slippage, going back to seminar 1, the price at which you sent the transaction compared to the price at which you're willing to accept for the trade to go ahead, that's your slippage. So, let's say you have a slippage of acceptance of 1%. So say it's 1%, it's fixed. So if the transaction, upon the point of you sending it to the point of the transaction actually going through, if the price discrepancy changes, if it goes above 1%, maybe someone's seen it and like they've kind of front run the transaction, they're going to buy the token before you, they're going to mark the token price up, and then the next block they're going to sell back to you. In doing so, because you set your slippage at 1%, that will not be possible. The transaction just will not physically go through even though it went to 1.1%. You have set your predefined you've set your predefined characteristics of what you want the trade to play out as. As I said, probably slide 2, if this then that. So it's a set of smart contracts that will act upon the person who is applying the input, right? So if you are going to go high, kind of like high slippage and it's fixed, you probably want to go G2 only. Broadcast mode for priority fee, you can kind of say, look, I'm willing to pay slightly larger amount as a bit of a tip, as a bit of a bribe, as a bit of a priority fee to make sure my kind of transaction gets approved, because validators have to get paid as well. And the way that they kind of optimize is not on this kind of first come first served basis, but it's usually through how much of a kind of fee and tip you're gonna kind of give them. So I always just set mine at 0.01 Sol. You can go as low as 0.0004 if you want, but I think this kind of just typically works well for me. Think about it, in times of high traffic, everyone's going to be trying to set their max cap a lot higher than what it is currently, so they make sure they get their transactions through. And then I always pay ultra. You can go exact fee or max cap. So if the transaction is willing to go through at lower cost than this 0.01, then that's completely fine. Or you can just say exact fee. I don't care. I just want it to go through. So then you've got some more advanced settings down here that you don't necessarily need to use. Direct route only is you do not want to use multiple liquidity pools. So think about it like, as I say, we're on Jupiter. It's a DEX aggregator, so it can source liquidity from Raydium. It can source it from Orca. It can source it from Meteora. If you want to go direct route only, I don't necessarily know why you'd want to do that, but you can kind of toggle that on. It will work. You can use Rapsol or AMM exclusion, where you can only choose to go through something like an order book DEX like Meteora. So that's kind of that. Get off. And then, as I say, you've kind of got your limit orders on here as well. So basically, I'm willing to buy this at this price, or I'm willing to sell this at this price. And you've also got your DCA function as well. So instead of just buying, if you got a little bit scared and you want to buy at the top, maybe you're thinking an hour you might get a better price, you can just set a DCA. So say, for example, 10 Sol. This is how much I want to send. This is how much I want to spend. Sorry, to buy this token. I want to buy it every minute for the next 600 orders. They do have like a minimum order for like such high throughput, but let's say I want to do it for why is that not working? Every hour for 48 hours. So you need a minimum. Yeah, so there is a minimum cost per DCA order, but that'll just go through. It'll populate here. You can kind of keep track of it. You can cancel at any time. Really good feature. Highly recommend it. And again, as I mentioned previously, you can just tap top right here and select for your RPCs. Helios seems to just be head and shoulders above everything else. So right, so that's vast majority of DEXes. Any questions? I'm just gonna quickly look at if we've covered everything before we get on to lending and borrowing. Yeah, transaction broadcasting. Basically, so the question was, what does the whole transaction broadcasting stuff mean? So when you send a transaction, basically that is getting sent, like on Ethereum or any EVM. Basically what happens is when a transaction gets sent, it gets sent to something called the mempool, which is short for memory pool. And then the transactions get ordered, and then they get submitted into blocks, and then they get stored on the blockchain. It's immutable, it's forever. There is a bit of a problem because when they go to the mempool, you get highly sophisticated actors with a shitload of capital and mev bots and all sorts of like value extractive kind of scripts that are running, where they see specific transactions and they just see how they can kind of manipulate them for their kind of like for their gain. So let's say by accident you've set your slippage off 50%. Not a good thing. You might have just slipped for whatever reason and pressed 50. So what you're saying there is, this transaction, I'm willing to accept a 50% price difference from the point at which I send it to the point at which the transaction gets filled, and what I'm willing to accept, right? If that's on a very low liquidity coin, and someone sees that go to the mempool, and this is only on EVM, it's quite slightly different on Solana, but I'll explain that in a second. Whilst it's getting processed, and it might only be a few seconds or a few milliseconds, a bot is most likely going to go run in, they're going to see that transaction, they're going to mark the price up of the token you're about to buy, because you said you'll accept a 50% difference in what you're sending and what you're receiving. And then you're going to buy in the next block because you've already sent the transaction, and then you're going to buy a really, really high price token, and then the people who've actually been in and sniped it right before you and sandwiched you, they're going to sell it in the next block, and they're not actually going to make any loss, and they're going to kind of take the difference. So the whole transaction broadcasting thing on Solana, it's slightly different. So you have, like, I suppose, lots of different validators all over the world. One of them becomes a leader for like this specific block where it's going to include your transaction. But when you send that out, again, on a much, much, much faster level, because Solana block times are 0.4 seconds, there's a shitload of bots all across the ecosystem wondering if I can extract some value out of this transaction. So transaction broadcasting is that, and that's how it works, like on a standard process. With Jito, they kind of make it a little bit more, what's the best word? The transaction broadcasting is done technically in private, right? So when you're sending out the transaction what you want to execute on, all of the network can't necessarily see that. It's a little bit more complex than that, but I don't want to kind of like go like into the depths of like how Solana validation works. But using Jito, it kind of like shields, I suppose the best way to think about it is it shields the transaction for any malicious actors that want to kind of front run your transactions or trades. Hope that makes sense. Cool. All right. So just get a quick drink. Where's the slide? Right. So lending and borrowing. So why would you want to lend and borrow, particularly when whatever you deposit in, you can't borrow the same amount? It has to be less. What's the point of that? Doesn't make any sense. Right. So you can borrow against your assets. You can reduce your capital gains tax. You can leverage. You can short an asset. You can loop an asset. And very, very tasty APRs, all through very, very simple money markets, right? So all the money market is a lending and borrowing market where you can come to something like Kamino or Aave on basically any other lending and borrowing protocol. I've got some Solana. This Solana, I never want to sell. Let's just say you're an early adopter of Solana and you got 10,000 Solana. And you know that's kind of like 2.32 million. You're happy, you never really want to sell that. But one reason you wouldn't want to sell it is because you're going to create a capital gains event. That's going to be quite juicy as well, with $2.3 million, depending on when you bought it. You also want to earn some yield on it. So you can get paid 6.59% currently just for depositing. And all your friends are having fun in the shitcoin casino, and you want to have a little go at that as well. So let's say you've deposited 10,000 Solana, $2.32 million. Then you want to go and take a small little loan of $100,000 in USDC against that. You can convert that back into Sol, and then you can go play in the shitcoin casino, right? If you play that out, the 6.59% over the year is probably going to make up for the 100K that you've just kind of deposited against, right? It's because 10% would be $230,000. 5% would be $115,000 roughly. So you're basically the APR that you're getting from people who want to borrow your assets that you've deposited is going to pay for the 100k or 150k, 15k that you've kind of taken out to play in the casino. So think about how the rich do it. That's basically what they do. They don't sell their assets because they don't want to pay capital gains. They just want to kind of borrow against them. So in a nutshell, that's basically how that works. I'll go back to the page just to kind of take you through it. So there's a whole load of assets you can deposit here. Solana, Jito Sol, which is a liquid staking token. You can deposit your stable coins. You can put as a GLP. If you want to just like look for yield, you can go and see which was the highest yielding and then kind of work backwards. So PYUSD, which is PayPal's stable coin, that's paying 25.9%. Really good. Just for depositing, which oh no, it's 18.1%. Sorry, I'm looking at the wrong number. So yeah, it's like you can just go and deposit any assets in here, and then it'll show you this LTV, which is loan to value ratio. So again, if we deposited, I don't know, 1,000. Oh, what have I done? Right. For the Solana market, if you deposit Solana in, let's say you deposited $10,000 worth of Solana, the maximum amount you can borrow against that is 7,500. Right. So 10 in, 75%, 7,500 out. And that's just to kind of give a bit of a buffer in case Solana decreases in price. So if you've deposited at a specific amount of time, right? Let's just say, let's say Sol's at $200, right? And you've got $10,000 worth of Sol, and you borrow 75% in USDC against that, right? If Solana, for whatever reason, pulls back to $150, so it takes a 25% haircut, now your deposit value is worth the same amount of what you borrowed. So then you're going to be liquidated. You don't have to pay the USDC back, but that, like the collateral that you deposited, that's gone. The protocol has to take that. They basically take a fee, so they probably liquidate it at $152. They sell it on the market, and yeah, they recoup the difference between how much they paid for the asset and how much they sold the asset for. So that's like the liquidation engine at work, and that's how that works effectively. So the other side of the market is you can, as you say, you can borrow once deposited. And why would you want to do that? So using our example again, let's say we got 10,000 Sol. We then borrow, let's say it's 2.3 million. So we take a loan of 50% against this. So we got 1.15 million in USDC out. What happens then if we just go and use the USDC to buy more Sol? Well, we've effectively just got a leverage position on Sol. And then what happens if we take the Sol and then deposit it back into Kamino and do the same thing again? That's called looping. So deposit one asset, borrow another, turn it back into the first asset, deposit it, continue to do that. And then you're basically just getting leverage exposure to the initial underlying asset. So, all right, what happens if we deposit stablecoins in? So we can deposit stablecoins, get a nice juicy 19% on stablecoins, which is ridiculous, really. And then what happens if we borrow Sol against it? Right? So we deposit stablecoins, let's say $10,000 of stablecoins, right? And we, what actually is that price? Oops. Bear with me a second. Oops. All right, so let's say it's 43.47 Sol, right? We deposit $10,000 in. Right, so we could technically at 75% loan to value borrow probably 32 and a half Sol, right? If we immediately sell that Sol for stablecoins, so you've deposited stablecoins, you've borrowed Sol, and the value of Solana at that time was actually no. Let's say we borrowed 90% loan to value, because when you deposit stablecoins, you are allowed to borrow more because the actual asset that you deposited is less volatile. If you then go and sell Solana, and Solana drops, and you have to rebuy back the 36.5 Solana, it's going to cost you less money to do so. So in turn, you've turned a profit by selling an asset that has dropped in price, and then you've bought it back at a lower price and then repay the debt. So that's how you can use a money market to short assets for cheap and get paid to do so. Right? So you can use these things to lever up, to earn yield, to go long, to go short. Very, very, very good product. Right, let's have a look. Cool. So yeah, you can go and find some good tasty yields on there currently. Really simple to use as well. So we've been through Kamino, we've been through Raydium, we haven't been through Cheeto. So if you were to go to your Phantom wallet and you click on your Solana, start earning Sol, you can go liquid staking, which basically means what happens is all the validators on the network that are making sure that transactions are not fraudulent and making sure it's running and make sure it's doing as it should. Basically, with liquid staking tokens, what you do is you deposit your assets with, I suppose, a custodian, and then they distribute the assets to a wide variety of different validators, so that USDC Sol example again. Yeah. All right. Let me just go back to Kamino a second, just to kind of reiterate how to use a money market to short Solana, right? So that's what we're technically doing here. You've got $10,000 USDC. You deposit it in, right? This says once you deposit $10,000 worth of USDC, you can technically borrow up to 90% in any other asset, right? So you go and take $9,000 worth of Sol, and let's say that works out to be 39 Sol, right? At current prices, at the point at which you take the loan. Sol overnight does a 50% drop because SBF's got out of prison and he sold those tokens, right? But you've sold the 39 Sol, which you borrowed, and now it only costs you 4,000 to go and buy them back. 4,500, sorry, 50% drop. So you're going to pay the Sol back. You bought the 39 Sol back. You pay it back, but it's only cost you half the amount that you've kind of swapped it for. So you keep the difference. You keep the margin in between, because you're not paying the dollar denominated amount back. You're paying the Sol amount back. Right? Does that make any sense? Just shout up if it didn't. Cool. All right. Where were we? Yeah. So staking, liquid staking providers like Jito or Marinade, or I don't know, there's a whole load. Sanctum. They will allow you to deposit your Sol with them into like this smart contract, and then what they'll do is they'll distribute the Sol off to loads of different validators to kind of remove like single counterparty risk, and then you're earning this shared yield between all these different validators that verify transactions on the network. As I say, you could go native staking with them and then they choose a validator, but you run the risk of them not having the best uptime, and there's a whole host of things that you just don't want to worry about. So liquid staking is the move, and you can do it directly in Phantom. So you basically just choose how much you want to deposit, and when you do deposit, you're going to earn 9.4%. currently on your Solana. You do not need to do anything. Just leave it as it is. It could be called Jito Sol, and that's it. It just compounds. You do not need to do anything. That's basically liquid staking. So there's a good 9.4% earning, and you kind of want to have the majority of your long-term position in a couple of different, like Jito Sol, MSol, maybe a couple of others, but definitely Jito Sol and MSol as the bigger ones, because Solana's inflation is still relatively quite high. And the same is true on the Ethereum side. You should probably hold a staked ETH from Lido or a METH. METH from Mantle. Like, these are good yielding assets. We literally just launched a article on METH today, actually, quite timely. But yeah, liquid staking tokens are like a really good passive way to earn yield on good underlying tokens. So farming and airdrops, probably just use something like cryptorank.io to kind of figure out which ones are going to be worth their while. So you can go to products. Where the hell was it? Product drop hunting. So it's cryptorank.io, and then product drop hunting. And then you've got basically a load of information. So the name of the project, the type of task which they expect you to perform, the update status, reward type, did they raise, what's their Twitter score? So basically an airdrop, you might have heard your friends say it's just free money, right? It's a part of I'd technically put it as part of a marketing spend for any project to use as a customer acquisition cost, and to use as like an incentive to get people to try new products, right? So Jupiter, they did a pretty good airdrop, and then done it in 4 campaigns. So you do like specific tasks, you use the protocol, you genuinely use it, and then you kind of got the airdrop. But people have kind of figured out they can kind of reverse engineer what people they want, what teams want people to do, and then farm it. Like they're running it on multiple different. Just a question on liquid staking. The yield got from liquid staking is from validators accrued because of validate. Yeah, exactly that. It's the average yield from all the stake distributed across lots of different validators, just to remove any single counterparty risk. And yeah, the vast majority of the yield is coming from the validation of the network. Yeah, correct. So people have figured out how to farm airdrops, and then teams have fought back with Sybil protection. So effectively saying, you're not just going to kind of farm us and then dump our token. The best airdrops are always the ones where you genuinely love the product and you use it very early on and you continue to use it. Jito one was quite large, and I had 1 sol staked and that's all the criteria was to give a 5-figure airdrop. One Solana staked, crazy. Yeah, so you can kind of go through here, check what you like, check what you don't like, see what's hot, see what's not. The ones that are like raising like large amounts of money probably not going to be worthwhile. Usually you're going to have commit some capital, commit some time, do a lot of tasks. That being said, if you've got a limited amount of capital but a lot of time, definitely go and have a look what's on the market. Go and read some of the blockmates articles. If you're in the mail deal section, there's a lot of airdrop reports and stuff like that that are really useful, so you can kind of like figure out what we're looking at and what might be worth farming. As I say, the Hyperliquid one was absolutely ridiculous, to be honest. There's been people that have made tens of millions of dollars from that thing, from just being early and using the product, and just life changing for some people. Absolutely crazy. So go and check that out. If there's any questions, drop them in chat. Lots of people in Blockmates Discord are always chatting about what they're farming and what they're using and where they think the next airdrops are coming from and stuff like that. So yeah, technically it is free money, but you do have a lot of capital commitments, time commitments. Quite opaque what you're actually going to get out the end of it. Some people get quite irate and start running out with their pitchforks towards teams because it gets crazy towards the end. And yeah, are you the one being farmed in the end as well? It's something you got to ask. Yeah, as I said, that Hyperliquid airdrop was one of the most recent ones. That was the biggest airdrop in history. Kind of crazy numbers that I've seen some people get. What would be a next good Magic Eden NFT platform just happened as well. I'm pretty sure that was really good. What's this saying? Botanics, potential airdrop, Babylon, Particle. So there's a load that are just continually going. You got to think teams need to get their token out, get it distributed, get it decentralized in the most physical way possible. See the Magic Eden ones happening now. You can go and claim your token if you'd previously used the platform. So it might be $10, it might be 100, it might be 1,000, it might be 10,000, it might be 100, it might be a million. Like, it's luck of the draw, but the good protocols that give a large distribution of tokens are the ones to kind of keep an eye on. But you never know. They keep cards close to their chest. So yeah, all right, cool. Next week, so stake Sol, get some Jito Sol, then deposit Jito Sol into Kamino, borrow USDC against it, swap to Sol, and then undo all the positions. And as a bonus point, go on Sonar Watch and find out how to see all your positions once they're in the positions where they should be. So yeah, anyone needs to take a screenshot of that or just watch that slide back. And then next week, final one I'm going to take some long needed time off for Christmas. So tools and best practices, then safe, essential tools for DeFi users, analytics platforms, SolScan, DexScanner, Define, DeFi Llamas, Solana FM, June Analytics, portfolio managers, security best practices, multi-sig wallets and hardware wallets for security, how to assess safety of a protocol, token sniffers to check for locked liquidity and if the tokens are legit, how to avoid common scams, staying up to date, research and use Blockmates platform, and then final homework. But yeah, that's it. Been a good one. Pretty long one, that one. My voice is hurting now. Any final questions? And if not, I'll join you in Discord. Nope. All right. Okay. Cool. All right. See you in Discord. If you want to check for a little bit more of a deeper dive on stuff, you can always join the meal deal. But as I said, vast majority of our content is completely free. Don't want anything for you. If you want to take it a little bit more seriously, the meal deal is available for you. Should be links in the description below. And yeah, if not, come join us in Discord. Come say hi. Over and out. Take it easy.